Welcome back to part 3 of our 3-part video series discussing potential strategies to optimize your retirement savings. I'm Jacqueline Gruber and this is Chuck Allison. We are proud to help our clients understand and maximize their unique United Airlines benefits. In addition to educating you on your benefits, we create personalized financial plans and strategies to help our clients achieve their short-term and their long-range financial goals. These videos were created to help outline some of the important topics that we discuss with our clients during the financial planning process. In this final video of our 3-part series, Chuck is going to talk about creating a plan for savings beyond your qualified retirement accounts. He's going to explain how non-qualified after-tax savings can be used to help design tax management strategies in the early years of your retirement. Many people mistakenly think the day you retire is the end of your journey. However, it's truly the halfway point. Just like when you're climbing up a mountain. When you reach the summit, you still have to climb down, and that can tend to be the most challenging part of the journey. But with appropriate planning, you can rest easy at night with confidence in your financial plan and your strategy.
There are several sources of income that a typical retiree will have at his or her disposal throughout retirement. In general, these sources of income can be categorized as either not taxable or taxable. Some sources of income that are not considered taxable income include any distributions from your AHRA, RHA, any post-tax PRAP or IRA contributions, Roth savings, brokerage savings, or any bank checking savings accounts. Some sources of income that are considered taxable income, which are taxed at ordinary income tax rates, include pre-tax funds in the PRAP 401k or IRA accounts, your PBGC or CPRP pension income or lump sums, military pensions, Social Security income, as well as any part-time employment income. We call after-tax sources of income green money. Green money can be used for various tax management strategies in retirement, especially in the early years. The taxable sources of income will be taxed as ordinary income at your individual income tax brackets. The tax system in the U.S. is a marginal tax system. This means that as the amount of taxable income increases, so does the tax rate. This pyramid provides a nice visual for how this works. Pilots who enter retirement with multiple sources of income, both taxable and non-taxable, maintain higher control of the taxes they pay both now and in the future. In addition, they can control the Medicare premiums that they pay. Now let's take a look at some common income strategies and the consequences of each. One of the more common income strategies we see for a pilot in retirement is strategy number 1. In this strategy, the pilot retires at 65 and immediately turns on the PBGC, Social Security, and then takes taxable distributions out of the PRAP 401k. All 3 sources of income are considered taxable income and will be taxed at ordinary income tax rates. In this example, the pilot is taking out a total of $150,000 worth of gross income, which moves into the top tax rate of 22%. Strategy 2 shows a different way for generating the same $150,000 of gross income. In this strategy, the pilot has elected to defer the PBGC and Social Security benefits and receives an increase in his or her benefit each year that this is delayed. The pilot then elects to take taxable distributions from the PRAP 401k only up to the top of the 12% tax bracket and then stops, avoiding moving into the 22% marginal tax bracket. The remaining gross income is then generated by taking out after-tax brokerage dollars. This results in a much lower tax liability for the same amount of gross income. Strategy 3 shows a pilot who has accumulated enough after-tax dollars, or green money, by retirement that he or she is able to generate all $150,000 worth of gross income from after-tax dollars. This pilot can then take advantage of the lower marginal tax rates by executing a Roth conversion alongside this. Any dollars that are converted from traditional IRA to Roth IRA are taxed as ordinary income. Once in Roth, these dollars will grow tax-free. The more after-tax money you have entering retirement, the greater the control and flexibility you have in designing a retirement income plan. The design of your retirement income plan will not only impact the tax liability that you pay today, but also will have an impact on the Medicare premiums you pay tomorrow. When designing the optimal retirement income plan, it's important to consider things such as future legislative changes, tax liability, and other goals. The best retirement income plans start by looking out onto the horizon into the later years of retirement. Here we are showing a sample of the sources of income we typically see for a retired pilot age 73. By this age, the pilot and spouse have turned on their respective Social Security benefits. In this example, the total benefit equals $6,000 per month or $72,000 per year. This pilot also has a $6,000 per month PBGC benefit. And starting at age 73, the IRS requires one to distribute a minimum percentage of your pre-tax retirement savings, which is called a required minimum distribution or RMD. This percentage increases with age. In this example, the pilot has a total pre-tax PRAP balance of $2 million, which results in an RMD of approximately $75,000. Let's assume that this pilot has some other investments such as dividend-paying stocks, bonds, and any other interest-bearing accounts generating another $20,000 worth of income. This pilot now nearly has $240,000 worth of taxable income at the age of 73. This puts the pilot at the top of a marginal tax rate of 24%. A pilot who looks out onto the horizon and sees their future top marginal tax rate of 24% may look to convert some PRAP now into Roth at lower tax rates, just like how we outlined in Strategy 3 on an earlier slide. There are many other variables to consider when deciding which retirement income strategy is best for you and your family. One significant change upcoming is the sunsetting of the Tax Cuts and Jobs Act in 2026. The Tax Cuts and Jobs Act reduced most of the marginal tax rates by 2 to 4%. This means that starting in 2026, those marginal tax rates will increase by 2 to 4%. This makes the federal income tax environment now much more attractive than what it is set to be in just a few years. You will also want to consider your individual state income tax situation, not only your current state income tax situation, but also looking out to what it may be in the future, such as, will you move to another state in retirement? What is the state income tax environment there? Your tax filing status may change in the future from married filing jointly to a single filer. This may be due to death or divorce. The Secure Act has also changed the way qualified assets are treated once inherited by a non-spouse. Beneficiaries now must fully liquidate any qualified accounts within 10 years of inheriting them. How many beneficiaries do you have? What is their tax situation? These are some common questions you should ask yourself when considering the best strategy for you and your family. Another important consideration is the impact that taxable income has on your Medicare premiums. Medicare Part B premiums are determined using the Income-Related Monthly Adjustment Amount, or IRMA, shown in the table here. Medicare premiums in the current year are calculated by using your modified adjusted gross income from 2 years prior. Some life-changing events, such as retirement, may qualify you to use your current year income instead of the 2-year look-back. Our team can help you work through this. You will notice that within each federal income tax bracket, there are several IRMA brackets, so it is important to fully understand the impact that your retirement income will have on the entire picture. This concludes our 3-part video series on retirement savings strategies. Thank you for spending some time with us to learn about some of the strategies that we educate our clients on. We understand that each and every one of our clients have a unique set of circumstances, which is why our team is standing by to get to know you and your goals and build you a personalized financial plan.